I can scoot a little closer. Hi, everyone. My name is Casey Wagner. I'm a reporter at Blockworks. I'm really excited that everyone's stuck around. I know we're cutting into happy hour, but excited to talk about macroeconomics. I'd love to start with an introduction. Aisha, did you want to start?
Sure. Hi, everyone. I work at Ledger Prime. We're a multi-strat hedge fund. And aside from Ledger Prime, I also teach blockchain at NYU Attended.
Hey, guys. I'm Ro. That's a little stale. My last day at Genesis was in March. So I used to work at Genesis for 4 years running their lending book. And more recently, I'm starting a new hedge fund with a couple partners we're launching soon.
Hey guys, I'm Tom Dunleavy with Masari. Before that, I was with an investment consulting firm and then investment management with State Street Global Advisors.
Great. Okay, so I'd love to kind of start with a broad overview of the current macro environment. Obviously, we're seeing some pretty hot inflation. It's kind of a weird time with the dollar up and crypto down. I think that creates an interesting environment for stablecoins, especially. So I'm interested to talk about that. But just more generally speaking, how are you thinking about the current macro environment and what are you watching?
So I think we'll probably see stagflation, but I would let others talk about it. But from crypto perspective and from the investing perspective, we have seen a lot of capital leave on the LP level because their LPs have either lost money in the equities market or just too spooked by the current crypto environment. So because of that reason, I think in past few weeks or so, we've seen the dust completely settling. The prices are semi-stable. And the market has started pricing in inflation rates and whatnot. So far, even though there's been a strong correlation, but we've seen so much of DeFi stocks, Beat, ETC, Avalanche, for instance, perform well. So I think crypto has overall been doing well for where the global macro could head.
Yeah, I mean, the macro situation right now is not really fun. It's kind of terrible, but like Aisha was saying, I think, as far as how crypto has performed, it's kind of in line with, what you'd expect as a higher beta to NASDAQ type asset. Things I'm looking for really now, what's interesting, rather than looking at the past, is kind of thinking about how things could turn from here. So watching really just energy prices really closely, Fed signaling. I think the July meeting will be super important. And in terms of long-term levels for crypto, where you're at right now on Ethereum, Avalanche, really just generally any of the layer ones, I think you're entering really good long-term attractive prices. So it's pretty comfortable to start buying spot, in my opinion. Oh, and I have to add, none of this is financial advice. Yeah, sorry.
Has that ever protected anybody? I'm never sure.
I don't know.
I put it on my put in your tweets. So. Yeah, so I'm just really watching inflation, and I try to dig into the components of it, because that's really all the Fed cares about right now, is when and if inflation will slow. So inflation has actually continued to accelerate. That's not only in goods, that's in services, that's in the headline things we see like energy and food prices that the Fed can't control, but also the underlying things the Fed can control, things that are affected by interest rates. So housing being the primary component. So housing's 40% of headline inflation, 30% of the inflation metric the Fed looks at. So what they really need to do is bring down the housing sector and maybe not crater it, but bring it down to a level that prices stop accelerating. You have prices accelerating 20% year over year, and you're looking at those numbers come in month after month after month. And the way those calculations actually go into CPI, it's with a lag. So all the price increases we saw earlier this year, they're going to be reflected in CPI in later Q3 into Q4. So you have 6 to 12 months of lag from all the price appreciation we saw throughout the year. So just from the housing component of inflation, we're going to have something like 4 or 5% baseline before you even get to that energy and airline tickets and all the other things that are contributing to inflation. So the Fed needs to continue tightening, if nothing else, just to slow down the housing sector. And you can already see it if you look at sort of the housing data. It's starting to happen already. So that's really what I'm watching more than anything else.
Yeah, I like that you bring up the Fed. Obviously, that's a core topic when we're thinking about macro. I mean, in terms of what you're expecting for later this month, in June, obviously, we saw a 75 basis point rate hike. Are you expecting the same? Are you expecting higher than that? How could that impact crypto and equities more broadly? Tom, did you want to start?
Yeah, so I think the Fed is just looking for air cover to go 100 basis points. The Fed's all about expectations. So if the market, this happened last month, they saw, there was whispers about 75 basis points, and then all of a sudden it was in the public, sort of the mainstream, and then they could hike 75 basis points. We're getting whispers about 100 basis points. They have sort of all the Fed governors go out and do talking circuits about it, and then see sort of how the market reacts to it. And once that could happen, and once the market function, the market reaction isn't adverse, they say, okay, I think we can hike 100 basis points. It's okay. And looking at all of the things that the Fed really cares about, obviously they care about employment. There are 2 jobs for every person looking for a job right now. Wages are still rising 4 to 5%. In real terms, after inflation, you're still losing money, but they're still very, very strong on an absolute basis. All of those things the Fed's looking at right now. Retail sales today, also strong. So all those things the Fed's looking at says the market's still strong, we have plenty of air cover to hike, so let's hike as much as we can.
I think it'll be 75 for what it's worth, not 100.
75, but I think that crypto has already priced that in. Yeah. So we're probably on a slight upward trend, but I think crypto is going to be stable again. No investment advice. I'm not saying go buy ETH or AVAX, but I think the crypto market has already priced that in.
Yeah, and Tom, I like that you bring up that the Fed certainly does not like to surprise markets. I always think that that's a good thing to keep in mind. And speaking about crypto, what could happen, inflation, I'd love to ask all of you kind of about the current correlation that we're seeing between crypto and equities. I think in May it peaked. Bitcoin and the S&P and Bitcoin and the NASDAQ were as closely correlated as they've ever been. It's fallen off a little bit, but how does that kind of play into that historical investment thesis of Bitcoin as an inflation hedge, Bitcoin as an uncorrelated asset? And how are you thinking about crypto just in regards to the broader market?
Yeah, sure. So I kind of think about crypto tokens in some senses as like a tree. So at the trunk you have your major layer ones, Bitcoin, Ethereum, Avalanche would kind of fit into that trunk, and then you have branches that are specific applications on them, like categories, whether it's AMMs or borrowing lending protocols, options protocols, and then usually those applications have their own specific tokens, which are kind of like the leaves. So when you see a broad market sell-off and all correlations start to elevate, I think your focus has to reshift a little bit to the trunk of the tree, because that's where kind of the beta will be. And you'll be fine to get broad exposure by focusing on that trunk, and realistically the leaves will probably perform poorly, or people will just generally care about them less when everything is behaving in sync. On the flip side, when you're in a later stage bull run and correlations are lower and there's more divergence amongst assets, I think that's the time to start focusing more on the application tokens and specific, AMM or DEX tokens and things like that. So right now, I think it's if you're going to think about buying a sushi or a uni versus just Ethereum, I think a better expression of getting the exposure is focusing on the trunk, and there'll be a time for it to shift. And you'll have to, look at the cyclicality of the overall crypto market and the cross correlations to break down a little bit to start to see that shift. I don't think we're there yet.
So one thing that I would say is that with time, in months to come, we'll probably see less correlation. The reason I say that is because, yes, Bitcoin is used to be a great inflation hedge, but some of the other projects have been outperforming it from investment purposes, right? So yes, I think it wasn't even in May, but we had started seeing investor fears, I think around February, March, the Ukraine-Russia situation, and that's when we started, market capital just getting sidelined. So what does that mean, for people like us that are managing it for others? We're, instead of our bets are being, on BTC or ETH as a whole, we're basically counting on smaller cap tokens because we have seen they're outperforming, and they're outperforming for good reasons, right? Like showing utility cases, real world asset cases, or, basically creating the right infrastructure that, what it needs. The latest CeFi versus DeFi, lending situation has been kind of the best example to show that why, crypto is here to thrive.
Yeah, so to date, crypto has performed like a high beta risk asset almost across the board. So what causes us to decouple? I think it's incremental flows up and above retail flows, which historically has been sort of what I think has driven most of a lot of the crypto sort of market cap. You need institutional investor adoption, and you need it sort of in size. You need to start to move into 1, 2, 3% place in a portfolio, for those institutional investors. And the only way we do that is by getting better regulation, better security, flushing the bad actors out of the system, all the things that people talk about. But we need incremental flows to actually make that decoupling happen and actually have crypto stand alone as sort of its own asset class.
I mean, given you all kind of each brought up, given like current situations in crypto, we've obviously had tumultuous couple months with 3 Arrows, with Celsius, with Terra. Having that play out with the current macro background has been a pretty interesting dynamic. How much of current market conditions do you think are reflected in current events in the crypto industry versus macro? Tom, did you want to start?
Sure. I think we would probably be down. Historically, the correlations are 0.7, 0.8 for Bitcoin and Ethereum to sort of the NASDAQ and S&P. We'd probably be down, 30, 40%. The S&P's down like 20% or something like that. That's where we would be without all of these blowups. So, and I think an interesting thing to look at is the last few days we've sort of decoupled, right? Yesterday, I think stocks were down 1% or so, and Bitcoin and Ethereum were up, 5, 10%. So can we start to see days like that in the future? It's going to be tough to see.
Yeah, I think there's some, endogenous to crypto events that have exacerbated the fall of crypto. Specifically, the Luna collapse, I think, did some irreparable damage to the retail bid. That'll take some time to come back. And then when you have Celsius and then 3 Arrows, what that did to institutional risk-taking, credit liquidity in markets is quite some damage there. So it's kind of like a 1-2 punch. You have the retail hit, you have the institutional hit, and I definitely think that got reflected in prices a little bit more. Had those things not happened, I would imagine we'd be higher.
Yeah, I was just going to add on credit liquidity, but basically, especially after Celsius and BlockFi, and then, Luna started it, there's literally, markets are not as liquid as they were. So, yes, very less opportunity to borrow anywhere. So, I think the prices, not to predict, but Bitcoin would have been around 30,000. I think so.
Yeah. Seems reasonable.
Yeah.
Agreed.
We have no idea.
Yeah.
Oh, yeah.
So let's just run it back and see if we can try that again.
No, because a lot of liquidations happen between 30 to 20. So, yes, it would have stuck around 30 had Luna was the only blow, but no, the blows continue.
Yeah, that's a good point too, because you get these cascading liquidations, because people can see where the target values are to sort of push someone's position and actually get it liquidated too. And then once you get down to that sort of new lower level, you kind of sit there and people mentally get it in their minds, Bitcoin now is 20K, let's trade around that, versus Bitcoin's 30K, let's trade around that.
I guess just in terms of what's happening in the macro environment, how is that impacting capital flow into crypto? And Aisha, I know on the planning call you brought up a really interesting point about LPs and how they're losing money in the equity markets, maybe not allocating as much to crypto or other risk assets. Can you expand on that?
So we are very much institutionally backed, and I'm assuming even Rose's new fund is too. What happened was right around the Ukraine-Russia crisis and right around after Luna was basically just it for some investors, where they said, look, we've lost this much money in equities, we need to pull it out of crypto because this is the riskiest asset for us, and we'd rather have no exposure to it. So we were fine, we said it, but then with time we started seeing some more redemptions. Again, people losing in oil, people losing in other commodities, people losing in equities, and then a couple on crypto side, especially Luna exposed funds. So that has changed. Now, whenever I get on an investor call, it's more like, how have we performed from May onwards, not early in the year. That basically just tests us on our stress test. And the check sizes literally went from 50 to 70 million for, just on the LP stage, now 10 to 15, because the appetite for crypto is kind of like not there anymore. It will change later in the year, especially around the merge. The good thing is that almost every institutional investor you speak to, they know about the ETH merge, they know where BTC stands, and they all have to admit at one point that crypto is here to stay. So that's why I think like early next year, each and every fund of funds or larger banks or whatnot would have like at least 2 to 3% of their book allocated towards crypto.
Yeah, I agree with a lot of what you said. I mean, right now we're actually in the process of fundraising, closing soon. It'll be public. Who some of our LPs are, and our anchors are very institutional and large. They've, I think, been a little bit more excited about the public market downturn, partially because their businesses are not focused on public equities and have, done relatively well. But some LPs we had that were formerly in that 75 mil check range are definitely lower. So in some senses, it's gotten harder. Specifically for us, just like anecdotally, one thing that's changed is when we were thinking about strategy for our fund in March, a lot of it did involve, running delta neutral cash yielding strategies and focusing a little bit more on private markets, just given where markets were. Now we've basically scrapped a lot of our yielding strats into a completely separate vehicle and are focusing a lot on liquid public markets, just because here risk reward relative to earning yield at these prices versus accumulating delta, we think has changed quite a bit. And I think the LPs have realized that too. And they're much more interested in like, double digit or let's say triple digit returns over 3 to 5 years rather than consistent yield. And we've kind of split it into a separate product. So that's kind of how this market has evolved, how we think about allocating just dollars.
Yeah, and we certainly don't talk to the allocators of capital as much, but we do talk to folks, sort of more corporates, and a lot of them are looking to get smart this cycle, which is, I think, different than last cycle. They want education. They understand, as you said, that crypto is going to be around in this next cycle. It's not going away, so we need to learn about it, need to get smarter, figure out a way to invest in it, and figure out smart people like Ro, how to invest with. So it's nice to see that people are taking that step this time rather than sort of writing it off, despite what you see in sort of the headlines on Bloomberg and Wall Street Journal and stuff like that.
And kind of bring it back to the venture standpoint, what kind of trends are you seeing just in terms of capital allocation? I mean, obviously there's been a little bit of a slowdown in funding, but just in terms of broader investment thesis, is there anything that Aisha or Ro, you guys can share?
Infrastructure, ZK, and NFT derivatives, lower valuations. Bear markets are great because this is the only time that builders actually get to build on limited amount of money that they could raise. And you see a lot more growth happening. So we've started seeing a couple of private chains. There was a word out on Aptos today, Sui. So that would be interesting, another set of layer ones probably coming out in the next cycle. Yeah, that's what we've seen so far this month or so.
Yeah, the way we kind of think about strategy in the venture space right now, or even just allocating in crypto, because we kind of view public market or liquid market investments, if they can provide venture returns, they're basically liquid venture investments. So we think of it as kind of like a barbell approach right now, where you have, let's say a barbell is early to late stage. We're focused on both ends of it very heavily, which is super late stage stuff that's proven, live, has revenue, whether that's a layer one, whether it's a token, whether it's an application, infrastructure, equity, that's great. And then also very early stage, things that haven't raised before, pre-product, super early things. I think there's a lot of valuation overhang in the middle, which is your Series A, B, C, because a lot of these companies raised in 2021 or even earlier, they feel entitled to not raise the down round. There's still a lot of money chasing the follow-on there. And some people can play that game. For us, we don't really want to get involved too much there. So we're really focused on the two far ends of the spectrum.
Well, I was going to ask Tom, I know that you're less engaged with allocators, but any predictions or any thoughts that you have just on investment thesis and current venture trends?
Yeah, I think everyone's all in on the modular thesis. So, it's really where are you building the next sort of, stack that you can accelerate your chain or your protocol? Is it going to be on an Avalanche subnet? Is it going to be on a Cosmos chain? Is it going to be on an L2? I think that's sort of the coming debate a lot of these protocols are having, and sort of who's going to win the day and who's going to provide developers and protocols with the best incentives to go to their protocols. I think is what we're going to be watching throughout this cycle. The thing that I don't think we're going to be seeing is more L1s. I think, Terra Luna kind of threw that out the window. So hopefully not a new influx of L1s that are taking funding from all of these protocols that are actually doing some really good things on Avalanche and other chains.
Yeah, definitely. And then just to kind of bring it back to macro a little bit, obviously inflation is the big headline right now. What kind of signals should we be looking for to kind of gauge whether or not we're in a recession, headed toward a recession? I've talked to a lot of analysts that have kind of said that will be the key pivot point for the Fed to kind of stop focus inflation and move over to recessionary, concerns. I'm assuming unemployment will be pretty significant with that. What other factors are you guys watching?
I think there's a difference between sort of a broader economic recession, which is, sort of 2 quarters of GDP down, checkbox for that one, and there's another sort of institution that looks at recessions, afterwards and says, hey, we're in a recession, which I don't really think's super meaningful. But the one that actually is meaningful is sort of an earnings recession. So if companies aren't able to pass along inflation costs to their consumers, if they're getting hit with sort of energy costs and their profit margins are declining and earnings are going down, that's sort of an earnings recession is when the stock market goes down, which if we still believe crypto is correlated, that could be trouble for crypto. So that's what I'd be looking for, earnings season.
Yeah, I mean, I definitely think a big narrative shift to watch out for is going from inflation to recession. I think at a certain point you have to ask whether the Fed cares more about the prices of groceries or how unemployed people are and how jobless things really look. And I think at a certain point they'll have to choose one or the other, and there's a chance that they signal that unemployment is more interesting or more important to them. I also do think you have to look at yields on the dollar versus our sort of neighboring economies or sister economies, particularly the ECB and Japanese government bonds. Arthur actually wrote a good post on this, and I've been kind of agreeing with this view for some time, which is now that the Fed has taken a very tight policy stance and then started to hike a lot. The spreads between us and the euro and the yen have widened so much that those currencies are worth way less. That's kind of hurting those economies quite a bit, and I don't think it's completely out of the equation for the Fed, at the behest of the US Treasury Department, to purchase foreign government assets, and that will effectively unload a good amount of easing into the marketplace while still maintaining the narrative that they're tightening in America, which they will be. They won't be buying American government bonds. They might be selling them at the same time, but just replacing them with other ones. So that's definitely one that could create quite a vicious move to the upside, and very quickly, if that headline were to drop. Got to really be quick on that one and look out for it.
I think we started seeing the slow effect of it, just going back to the job part in crypto, right? Like OpenSea, Coinbase. We'll probably see a bit more layoffs, and that would, probably make this a bigger topic within the community itself. But yes, everything that Ro and Tom have said, I'm agreeing to that.
I hate to get too speculative, but I'd love to kind of hear you all's thoughts on what could turn this market around. Can crypto come back without a broader rebound in equities?
Uncollateral lending on DeFi. That is it. I think each and every builder should go ahead and build it. This market has shown a great need for it. So I think the next cycle, we're probably seeing more stronger applications of DeFi. And I think this is something Rose already said earlier, even on the options side, like derivatives, that's 50% of our fund. We've seen such a huge growth despite of where the market stands in past 2 to 3 months alone. So that's my tip, which would bring the cycle back.
You want to go? I need to think about this a little more.
Yeah, I'm just going to say the merge. I mean, you just need something that brings in institutional adoption or more money into the space. And if you're just having broader global liquidity conditions contract, people need to, take their cash and do something with it and pay their bills and, pay back their debt holders and things like that. And they're not putting it into more speculative assets like equities or crypto. So you need those broader liquidity conditions to sort of ease up before you really can do anything. And the merge might push that flow.
Yeah, I agree with that. I mean, I wish I could say that there was like some sort of specific application or something that could single-handedly turn around the market. I don't necessarily think there is. Maybe the merge is like the closest thing to that, but I think there's a couple different spectrums of risks that you have to look at. Well, one is the spectrum of where interest rate policy sits, like the Fed. Whether it's tight and credit is tight, or credit is loose and rates are low. That's one. The other is more of like the geopolitical risk landscape, like whether there is an elevated geopolitical risk regime or things around the corner, or lower geopolitical risk. And then kind of in that same vein is globalization, like how vertically nationalism-oriented supply chains are versus cooperative and sanction-free and tariff-free. So I think right now where you sit, and if you look at all these metrics over time in history, they sometimes they flare up around conflict and war, like World War II, Vietnam War, and right now they're flaring up as well. But they kind of look like the chart of the VIX. They come off after. So you're going to want to see all those things start to shift back, like reduce sanctions, reduce tariffs, lower geopolitical risk. Like Taiwan is completely off the table to talk about next year. Hypothetically, if that were true, that would be good. So all those things I think will help bring investor ease back into the market, because that's kind of where I see like things really turning. And then, on a more acute sense, like yes, there could be the merge, Ethereum becoming a really great deflationary asset, unsecured lending on DeFi. I actually think it's a pretty important thing. But I think those will be secondary to the broader shifting across all those spectrums. I
have a question for you. What about the capital that's like literally on sidelines, even within the industry and, even institutional investors from 2021? Do you think that's getting allocated anytime soon, or?
Well, I think a lot of that capital likes clarity, and they're actually happier to buy things like 50, 60% higher, whatever, as long as it's like a good backdrop tailwind. I think right now the prices are attractive, but the backdrop tailwind, they're still being patient for, from what I've gathered. There are some sort of more gung-ho traders that are like, you know what, we love this price, max bidding, maybe the Saudis, no, I don't know.
Heard it here first.
But yeah.
No, crypto's kind of a weird asset, right? It's almost more justifiable for sort of more of the buttoned-up crowd when it's at 30,000 than versus when it's at 10,000, because they have the justification, say like, hey, this thing's going up. Hey, it's going to be a real thing. So the more it sits in sort of these ranges, the more justifiable it becomes for an investment.
Oh yeah, one thing I forgot to add was the stable coin wariness. Like there's a huge percent of people that like don't take crypto seriously because of Tether, and now even USDC, like people are like, oh, USDC is insolvent. I mean, all that really needs to be squashed and put to bed to regain some credibility, even though we know, kind of what's good, to regain sort of broader outside of the crypto market credibility. So I think that all that fear has to be behind us. Right now, people still talk about it. And like Jeremy Allaire is literally writing line by line what's in this treasury. And it looks fine to me. So as long as people start to realize that, that'll be good.
And then last question, we only have a minute left, but just back on this like correlation train. I mean, can cryptos bounce back if we continue to see a significant sell-off in equities?
It always bounces off around the BTC. What's the 4-year thing? God, like
merge. Not merge.
Happening.
Happening. Yes, it always bounces back around that time, because around that time the market realizes, oh my God, less BTC to buy. So that's always a shift. But on the next uprise, it'll probably be Ethereum more, and then other tokens following, other layer ones following. But obviously, it's definitely going to bounce back. I would say probably another year or so.
Wait, was your original question if equities fall, is crypto going to rally?
Yeah, can crypto rally if equities keep falling?
I don't think so, no. Sorry.
Yeah, I agree. Unless we get some awesome regulations that say, I don't know, whatever, provide some clarity that'll bring some sort of incremental flows, I don't think crypto.
Yeah,
could
I
work
mean, I
macro
think
doesn't.
you all brought up stablecoins. I think regulation to the stablecoin market is by far going to be the first significant policy that we see.
I also think it matters why equities would be falling. Like, right now it's more policy driven. If we're in a low interest rate regime and equities are falling because the growth multiples are too high and earnings are low, but like there's still a lot more capital willing to allocate risk and shift, then you could see a decoupling. I think maybe in like 2018 you might have seen that, or around 2018, 2019, where crypto and equities had bottomed, but then crypto behaved completely differently in 2019 than equities at times. But that was a low interest rate regime, and people had, equities were moving differently from crypto. So I think in a high interest rate regime, all eyes are on the same stats, and it's really unlikely if equities fall, crypto is going to rally.
Yeah, I guess the last thing I'll add is, the more cycles we're around, the more different interest rate regimes and sort of monetary regimes and fiscal regimes crypto can go through, the better it's crystallized in the heads of institutional investors what this asset class is and where to put it in a portfolio, and the better it is for crypto. So, we just need more and more time, which is going to happen.
Well, certainly a lot to watch. Thank you all so much, and thank you for joining us.
Thank you.